Hi, this is Clay, the FAFSA guy, and we're talking today loans, direct subsidized and direct unsubsidized loans. Just want to make a short message that a lot of people might find and see that there used to be a thing called the Perkins loans. The federal government hasn't renewed those, so those are only grandfathered for students that are still in school and have those. So the loans that we're going to be talking about are the direct subsidized and unsubsidized loans that go to the students. The interest rates for this year are 4.53% for both the direct subsidized and unsubsidized loan, and it changes every year, and this is for the 2019-20 school year. The fee for the loan is an origination fee, and it's taken off the top of the amount that you get. It's 1.062%. So for an example, if you were borrowing $1,000, you would get 990 in a disbursement. If you were borrowing $2,000, you would get 1980 in a disbursement. So the origination fee comes off the top, it goes to the lender, and basically you're paying for the full amount. The amounts of loans that you're allowed to get as a freshman dependent student, where you have parents that do the FAFSA, you're allowed 5,500 in loans for the first year. As a sophomore, you're allowed 6,500. As a junior and senior, you're allowed 7,500 in loans. Now, subsidized loans are ones that are the better loan. It is subsidized by the federal government, which means the interest that accrues during the school year is paid for by the federal government, so you don't have to pay for it. So the nice thing about subsidized loans is when you borrow 1,000, that's all you have to pay back is that 1,000. It does the interest while you're in school, while you're not paying the loan, does not grow and add to your principal. Now, on the unsubsidized loan, it's not subsidized by the federal government, so it actually grows. So if you borrow 1,000, the interest for that first year is added to the principal. Then the interest is added to the second year and third year and fourth year. So that $1,000 becomes quite a bit in that, unless you pay the interest during the school year time. On any of the loans, you can pay the loans back at any time. You can pay the interest only if you want to. You can typically pay the school, or you can go directly to the lender. After the loan is dispersed, there's 9 lenders. They're like Mohila, Nelnet. There's quite a few different lenders that you can go to, and you'll find out who they are on the websites that I'll tell you later. But you can find out who the lender is, make interest payments or make principal payments. For independent students, students without parents, and who are older, say they're 24, 25, 26, and they're going for an undergraduate degree, their loan amounts are 9,500 as a freshman, 10,500 as a sophomore, 12,500 as a junior senior. Now, the amounts of loans that you can get, subsidized is maxed total for your total that you can get for a freshman. You get 3,500 in subsidized loans. So that means you get 2,000 for unsubsidized loan. As a sophomore, you can get 4,500 in a subsidized loan. That means you get 2,000 for unsubsidized, making your total 6,500. And as a junior senior, the maximum you get is 5,500 subsidized loan and 2,000 for unsubsidized loan. And those are the maximum you get. And remember, subsidized is the best. There's some students, like myself and my son, who never got a subsidized loan. Our parents made too much money. I made too much money. And my son only was offered unsubsidized loans. Sometimes you can get differing amounts. So those are the maximums that you're allowed. And many students get only unsubsidized loans. Now, the total as an undergraduate, as a dependent student that you can get in loans for your 4 years or 5 years or 6 years, however long it takes, is 32,000. The most that you can get in subsidized loans is 23,000. So as a senior or fifth year senior, you might be running into loan limits. So you can only get 23,000 in subsidized loans, and then the balance can be unsubsidized loans of a total of 32,000 in loans. As a independent student, one with no parents in doing that, the maximum loans that you get are 57,500. The subsidized limit is still the same, it's 23,000, but the maximum loans you get are 57,500, which is quite a lot for a 4-year degree. A lot of students will switch schools. The numbers go with you. A lot of students will change majors and take a long time. Those numbers are hard numbers. There's no other loans that you can get once you hit your maximums from the federal government. You can do private loans, and that'll be another video that I'll go over with you that goes over private loans. Now, you can pay interest in the principal down, like I said, at any time. You won't have to be repaying the loans back until 6 months after you either A, graduate, B, leave school, and that means all schools, or C, go below halftime, and halftime is 6 hours. So if you're taking a 3 credit hour class in the fall and then 3 credit hour class in the spring, you're below halftime and you'll start having to be repaying those loans. So remember, it's 6 months after you graduate or 6 months after you just leave school totally, and that's all schools, or you go below halftime, and then you'll be asked to repay the loans. If schools make a mistake or they don't update their things, you can get the loans deferred and in-school deferment, but make sure you have 6 credit hours per semester. We don't include the summer in the deferment or in the requirement to be taking classes. Summer is not required for students, so just know that. You'll typically have to do a master promissory note, and that's your loan agreement that says you'll pay back the loan. And you would go to studentloans.gov to do the master promissory note, and then you'll have to do counseling. Typically, at the beginning of your term, you'll have to do entrance counseling, and then towards the end of your school career, you'll have to do exit counseling, which goes over how you repay back your loans, the different terms for your loans, the different types of loans that there are for repayment. And that's exit counseling. Typically, I see after 100 hours because most degrees are 120 hours. They want you to know what's going to happen in the near future. Some schools will require you to do second year, third year, and fourth year loan counseling, so that's up to each school. But what is definitely required for all schools is doing entrance counseling and exit counseling before any loans are dispersed. You would do the counseling at the school websites if they have that, or at studentloans.gov. So again, remember to know what your FSA ID number and password is. So that's it basically about loans. They're not required for you to take. They don't check your credit for it, but they're part of your credit score. So if you don't pay them back, there will be a negative looking on your credit score. It'll be negative on your history. But realize any student, whether you're 17 years old or 16 years old, if you fill out the FAFSA and you do that and you've been offered loans, you can take the loans. They're not, the only thing that the government looks at is how many loans do you have? Are you at your subsidized limit? Are you at your unsubsidized limit? And they look at that, but those do go to each student. They're an award, they're a part of your FAFSA. So a lot of students say, I don't want any loans, and that's great. But if you don't have offered grants and your parents aren't helping you, that might be the only way that you have to do it. If you have any questions about loans, feel free to post after this. I'll be doing videos on Parent Plus loans, private loans, and other options also. But this is about federal student loans, which is the direct subsidized and direct unsubsidized loans. Thanks a lot and have a good day now.